Boom and bust cycles. A bubble, in economic terms, is any industry where people think that they will get rich because the value of that thing will never go down. They buy at one price today, and tomorrow the price is higher. So they can sell tomorrow and make money. They think this will never end. In the 1920s, actually, people thought the stock market would always rise. Your average person, your average housewife, your average just regular Joe would get up in the morning, and all across the nation they would open up the paper, they'd look and check their stocks. Everyone was invested. Because at that time, stocks would always rise. You would put in a little bit of money today, the next day it'd be worth more. You'd put in a little bit today, a week, it might have doubled or tripled. So what are people doing? They're throwing it all in there. If you think it'll never go down, you're going to over leverage yourself. You're going to, put in twice than you actually have, or 3 times, etc. And for a while this was working. People were getting rich. Everyone was getting involved. In the late 2000s, people thought the price of a home would always rise. We remember this recently as the housing bubble. And you remember all those television shows which are still on today, Flip That House, and all these television shows where someone would buy something one day, you could turn around the next day and sell it and make $1,000. Sell it in a month, you've made $10,000. You improve it a little bit, sell it, 3 months from now, you've made $40,000, $50,000. People thought this would never end. They're building these large projects. Little McMansions, so to speak, are just popping up all over the place. People thought you can't go wrong in housing. They said price of a home will never go down. In the 1600s, actually, people thought the price of a tulip, yes, a tulip, a flower, would always rise. In fact, there was a tulip bubble in the 1600s. But of course, pop. The bubble bursts. People realize that that thing will not always increase in price. They've over-leveraged themselves. They've gotten themselves in trouble. In the 20s, bubble burst. And they said, okay, pay me the money you owe. And you said, well, wait a minute. I thought it was always going to go up. People went bankrupt. They lost their shirt, lost their homes. They were out of work. They were bankrupt. Because they thought I could put in twice than what I owe right now. And it's okay because tomorrow I'll make all my money back. And all of a sudden, their margins were called. They didn't have it. Same thing with the housing situation. People got in over their heads. How many of us have driven by a large, beautiful house that no one's living in and it's still got the construction sign in front? Because someone got into it, thought it was just going to keep on going, and all of a sudden, they ran out of money. That home's just sitting there. Once again, same thing happened with tulips in the 1600s. You can look that one up on your own. The process of this bubble growing, and growing, and then bursting is called a boom and bust cycle. These bubbles are fed by the money being pumped into the system by the Federal Reserve. Money is easier to get when the Fed is just creating it out of thin air. This causes people to make bad decisions with it. It's more complicated than this, but this is the summary.